Hello, everyone. Welcome. Thanks for joining us this afternoon for our monthly Copperleaf Roundtable. This afternoon's guest is Mark Maurer, President and CEO at LLIS in Tampa, Florida. And we've been working with Mark for a number of years. Mark is a graduate of the University of Florida and also Emory University, I believe.
That's right.
My alma mater, so I'm glad that we have that connection together with the University of Florida. Mark has extensive experience with insurance, both life insurance, disability insurance, long-term care insurance, and others. And we use their team extensively. And I want to start off by thanking Mark for all the great service your team has provided to our clients over the years. It's so refreshing for us to know that when we have a client with an insurance need as part of the comprehensive planning work that we're doing with them, that we have a resource that we can go to your team and you guys can provide quotes from different insurance companies in an unbiased way that we can, as fiduciaries, use with our clients to help them sort out their insurance needs. Mm-hmm. And then your team is so great at holding clients' hands through the process of the insurance application and underwriting. And I just want to start by thanking you guys for the great service that you provide to our clients. I don't know what we would do without it, because we certainly want to help people meet those insurance needs. So first of all, thank you you and your team for doing that.
Oh, thank you for such nice words. I started here in 2003 and was hired by Judith Maurer, who I call Mom when we're not in the office. And so I learned so much from her about the right way to work with people. And Keith Maurer, who I call Dad, still comes into the office most days and helps me with illustrations and quotes. So I learned from two of the best.
That's fantastic. Well, you guys are great. Today's topic is long-term care. And I started thinking about this actually last year when the pandemic hit. Mm-hmm. And nationwide, it was nursing home facilities across the country, especially in Washington State and then others, that were hardest hit by the pandemic. And it got me thinking about, oh my gosh, what's the impact of that on the nursing home industry, on long-term care in general, and how might that affect people's planning? So we're going to touch on that a little bit. I know you and I talked recently about how COVID may have affected long-term care insurance and kind of the whole approach. But before we do that, before we get into that, I wanted to kind of take a step back and, for our audience, cover some basics about long-term care. One of the reasons that we look at long-term care within the context of people's planning is two things. There are two primary factors, but the cost of long-term care, whether it's an assisted living session or a nursing home, can be high for people, and that can be devastating to one's financial plan. We have our first poll question up, and we're asking the question based on 2020 data. We got this nationwide polling research. If you just take a second and ask the question, what do you think the average cost per month of a private room in a nursing home would have been last year in Vermont? And just ask everybody to take a second and answer that question, and then let's see what our results are once we get that in. But so that's the first thing that we look at, is because of the cost can be very high. We want to understand the impact of that care on people's financial lives. Also, one of the things that I think about is choice for people. How does that impact choice? So we got our poll results back. If people are curious, about 25% of the group said they thought it was $12,500 a month. And about 50% actually got it right. The right answer was $10,500 a month, which is a lot of money. And that's really the reason that we look at that over the course of a couple of years. That's a couple of $100,000, and that's a big chunk of change to come out of one's financial plan or portfolio that can make a real difference in terms of having enough money to last or passing along money to the next generation. So Mark, talk us through the basics. We understand that it's expensive to provide coverage.
Mhm.
A lot of times people say to me, well, doesn't Medicaid or Medicare or, don't the government insurance programs pay the cost of that? How should we think about those government programs to help us with long-term care expenses?
Sure. Well, and I think that's a common thing that people fall back on. There's usually a survey every year or two from some insurance companies that say 70% of people think Medicare or Medicaid is going to cover the long-term care expenses. And as we talked about last week, Medicaid right now is the largest payer of long-term care expenses in the country. But in order to qualify for Medicaid, you have to have spent down your assets to essentially basically $2,000. You can have a house, you can have a car, but basically have little to no assets in order to pay for care, or you have to spend down your assets to a level where you're eligible for Medicaid. Medicare, most people have that by the time you get to 65 and start to potentially be in the normal age ranges where you start qualifying and looking at needing care.
Mm-hmm.
But Medicare is going to pay for 20% or pay for full coverage for the first 20 days if you need care. It pays a percentage for the next 80 days. So any Medicare benefits for long-term care, that's a lot of cares. Medicare benefits for long-term care stop after 100 days.
Uh-huh.
And even then, there are qualifiers of how you became eligible, which normally involve being in the hospital for a certain number of days. And so there's a number of qualifiers, but it's called long-term care.
Mm-hmm.
We just said the max is 100 days, which 100 days seems pretty short to me in the scheme of life.
Mm-hmm.
So it's not really there to cover the long part of long-term care.
Mm-hmm. And does for those first 100 days, do I have choice? Like if I'm in a, if I have to go, or my wife has to go, or my parents have to go into a facility, well, for that first 100 days, will they pay for, is it limited to what they'll pay for? Will they pay for any facility that I choose to go to? And I'm thinking about choice, you hear horror stories about, good nursing homes and bad nursing homes. And, I think our audience probably wants to know that they, if they need care or one of their loved ones needs care, that they can go somewhere that not only they can afford, but that's going to provide them with the quality that they're looking for. So how does that work?
And it's much more so with Medicaid, because there are certain facilities that agree to take Medicaid recipients. I know that there are some facilities, we're here in Florida, which is where kind of everybody comes to retire. So I know that close, there are some facilities that have a limited number of Medicaid eligible spots. And if that happens to be the facility next door to your kids and you're on Medicaid, you may wait until a spot opens up. From my experience, Medicare is, again, because it's not necessarily a long-term, it may not cover long-term, facilities are less, there's not as much of an issue if you have the Medicare, because the facility is probably going to get most of the benefits, but again, it's a short time. And so they're probably looking to make sure that this person can continue to provide, to basically continue to pay once that 3 months is up.
Yep. So because these government programs are very limited in terms of what they provide, then looking for alternative ways to pay is really what we're talking about. And for most of our clients, that choice is either paying out of pocket and making sure there's enough money on hand to do it and essentially self-insuring, or looking to an insurance company to provide that care. Now, I think there aren't a lot of, correct me if I'm wrong, but there used to be a lot more insurance companies that provided long-term care insurance. hasn't that changed some over the years? And what's been your observation with the companies that are providing long-term care, and kind of what's the status of that right now? Can we readily find long-term care insurance policies kind of anywhere, or what's the deal?
A great question. Long-term care is still the baby of almost all the different types of insurance out there.
Hmm.
So when a lot of these policies were introduced by lots of different companies, it was in the 70s and 80s.
Mhm.
And my parents told me, I think, that their first mortgage that they got here in Tampa was a adjustable rate for, I think it was 14 or 15%.
Right.
Rates were amazing. So when you, at the core, an insurance company collects premiums and invests it to pay future claims and liabilities.
Right.
If you were pricing long-term care policies in the 1980s, you might have said, we're going to be really conservative and assume 6% interest
Mhm.
all year.
Mhm.
Well, we're not at a 6% interest rate environment now. So one of the issues with it, a lot of these companies saw that interest rates kept coming down, and so their assumptions of the cost to future liabilities had to be adjusted. And some companies just decided either this isn't a big enough part of what we do, and rather than spend time and resources revamping this, maybe we'll just service the policies that we have on the books, but not do anything more.
Mhm.
Other companies said, we think this is important, so we're going to stay in the business, but what they've done over time is reprice the policies. And so if you purchase a policy today, it has a lot more interest rate knowledge built into it, let's say, at lower rates, assuming low rates for a long time. They have a lot more experience with how people use the benefits. Back in
I also heard years ago, not that many years ago, that also some of the earlier companies that got into providing long-term care insurance had really underestimated the number of people that would go on claim, the number of people that would actually need long-term care. Is that true? And do you have any numbers that you can share with our audience about how common is it for people to actually need to use their insurance if they have it? I mean, my fear would be if I had a long-term care policy that I'd pay the premiums for forever and never use it. Of course,
Right.
I guess it's a double-edged sword, right? You hope you never do, but
right.
on the other hand, I'm paying for it. I want to get some benefit out of
Right.
it, I suppose. What's the likelihood of someone needing care, say a 65-year-old? Do you know any numbers around that?
Off the top of my head, I think there are some different numbers for men and women,
Mhm.
and those I don't have off the top of my head. But I think it's about 1 in 3 people will need. Once you get to age 65, you're going to need care at some point in time.
Mhm.
Now, what happens many times is if there's a couple, one spouse provides that care. And this is where those numbers are hard to quantify, because spouses taking care of each other don't necessarily fit into any of those care surveys or buckets. So
Mhm.
care, a lot of the surveys are based on, did somebody get paid care? Because they can track those things. They don't necessarily know how many times a husband or wife is taking care of each other for a little while, a year or 6 months, and then go on claim because it gets to a point where they just can't do it themselves.
So one of the things I think I'm hearing is that the cost of providing care is a little fuzzy, or can be a little fuzzy, when we're thinking about it from a planning standpoint and looking at our clients' assets and helping them think about their portfolio and planning for the future. That $10,000 a month figure that we saw in the poll in the beginning is really for private nursing home care, but there can be other costs. Having a nurse come into the house for home care, and things like that. When we think about insurance, do the long-term care insurance policies only cover facilities at a nursing home, or do they cover other types of coverage, like at home and things like that? How does that
Right.
work?
They cover more, and to your point a little bit ago, some of the policies when they were issued in the 70s and 80s just talked about facility care.
Mhm.
But then assisted living facilities weren't really a thing yet. And so a lot of those older policies over time said, we'll include assisted living facility as a benefit.
Mhm.
I'm in the land of assisted living facilities. I've been to places that are nicer than some hotels I've stayed in. One had a smoothie bar, and so it's not, it's no longer that place that we sort of dread when we think about the nursing home from horror movies.
Yep.
And so that was another issue where the claims were more than they expected, because we were introducing this new thing that nobody had ever heard of,
Mhm.
that wasn't either you were in a nursing home or not. And
Mhm.
we've had those more levels of care. But today, traditional long-term care policies are going to cover that care in a nursing home, an assisted living facility, with a adult daycare, where sometimes these people need supervision but don't really need that hands-on sort of medical expertise,
Mhm.
or care in the home.
Mhm.
And so there's a lot more ways or places that people can receive the care for long-term care, and I think most people want to, if we can, receive the care at home. And so when we start looking at the costs of looking at particular policies, like our number showed, 10,500 a month for a private nursing home, but somebody may only use that for the last 6 months of their life.
Mhm.
They may have been in an assisted living facility for a year, or at home for a year and a half. And so a lot of times what we do when we're looking at policies, should the policy cover $10,500 a month and potentially cover everything that we could think about? Or if assisted living and home health care is $5,500 a month, let's say,
Mhm.
sometimes we'll look at let's have a policy that covers $5,500 a month. That way we kind of know we're utilizing the policy to the fullest, whether it's for care in the home, whether it's an assisted living facility. If you are in a nursing home, well, then you may have $5,000 a month of additional expenses that you were self-insuring.
Mhm.
But sort of with all things insurance, and I'm an insurance person, but still I balance what I'm going to pay for my insurance and what it's going to cover.
Right.
And I even do that with my own, even my own life insurance. I want to make sure I'm worth more alive than dead,
Right. Right.
or else one day my brakes won't work. But we don't really have hills around here,
Right.
so
Right.
but so many times we're looking at that as people who have some assets, and by working with you, they have some assets, they have some things that you're helping them with.
And I think that's a really good point, Mark. And I've learned that from you over the years, that we don't necessarily want to provide insurance for 100% of the anticipated need, but
Mhm.
let's protect the portfolio, protect the assets from a good chunk of it. But we may end up self-insuring for a part of that need, especially like you say, and maybe it's for the latter years, but we can provide insurance for a good bit of it to really
Mhm.
protect a good chunk of the assets moving forward. And I think that's
Right.
the smarter way to go, and certainly a lot more cost effective when we're looking at premiums that we may have to pay premium for a good number of years to have it in force when we actually need it.
Right.
What are some of the other components when clients are looking at long-term care policies? We've gotten quotes from you before, and I think if I was a client and I just saw one of those quotes and didn't have somebody to help me understand it and look over it, I would think, oh my gosh, what are all these different pieces?
Right.
Help us
Okay.
understand the most important, maybe 4 or 5 components of a typical long-term care policy that we should be thinking about. I know there are
Sure.
things like waiting periods and pools. Walk us through
Mhm.
kind of the 4 or 5 basic things to think about.
Okay, sure. So I have 4.5. So
Great.
there's a half. So the first one we touched on a little bit is the elimination period.
Yep.
And this is it's a deductible. And lots of times when we think about deductibles, normally we think of it as a dollar amount, but this is more of a time amount. So if I had something where I needed long-term care today, I would file a claim.
Mhm.
And if I have a 90-day elimination period, the policy says you pay for care yourself for the first 90 days, and then benefits are eligible, and then we'll start paying.
Yep.
90 days is 3 months, which a lot of people recommend you have it as an emergency fund.
Mhm.
It also almost lines up with that 100 days of Medicare.
I was going to say that
benefits.
seems like that covers that Medicare period.
It's close. Some of the older policies actually had a 100-day elimination period. I think over time people weren't sure why 100 days, and so the 90 days, 3 months just sounds a little bit nicer.
Mhm.
So you have that elimination period where you're waiting to receive benefits.
Yep.
We commonly look at the 90-day. You can look at a 180-day elimination period, and it will reduce the premium a little bit.
Mhm.
If you went to a 60 or even a 30-day, you're increasing the premium quite a bit. So
Yep.
there's a little change to go a little bit longer, a big change to go shorter.
Shorter. Yep.
So we have the benefit period, or the elimination period.
Mhm.
Then we have the monthly benefit, which we just talked about.
Mhm.
And that's how much, if it's a $5,500 monthly benefit, then it's long-term care policies normally work on a reimbursement basis.
Mm.
So if you're in a facility and cost was $500 or $5,000 this month, and you have a $5,500 monthly benefit, you're reimbursed for $5,000.
Yep. For the actual expense, they're not
For
going to
the-
reimburse you for more than you spent.
Right, exactly.
Right.
And then the nice thing is that $500 for this month that you didn't use stays in this pool of benefits.
Uh-huh.
So it's not here's how much you have each month, you better use it, or it disappears.
Mhm.
Which leads me to the benefit period. Most of the time, long-term care policies are defined in a number of years. So it's a 90-day elimination period, $5,500 per month for 3 years or 4 years.
Mhm.
That is the maximum amount of time. If you use the $5,500 per month, every month, it would last 3 years or
Mhm.
4 years, what have you.
Mhm.
I think we understand that a little bit better, but it's not perfectly accurate, because really what you have is a pool of benefits that is equal to $5,500 times 12 months times 3 years, which I can't do that math in my head.
Mhm.
But what it allows you to do is take out up to $5,500 out of that pool
Mhm.
per month.
Mhm.
So using my example, if home health care was only $2,750 a month, which I think I did that math right,
Mhm.
and I'm only taking out 50% of that $5,500 per month, potentially it's now a 6-year or 8-year pool, because that money I'm not pulling out now is staying there to be used later.
That's a great thing. So we can really think about that in terms of kind of managing the cost, is think about that pool, and people gives a certain amount of choice to kind of how they use that pool and how they make that that benefit work.
Right.
I
Right.
want you to get back to the 4 or 5 elements, but there's one other thing that I want to ask about that's related to that pool, which is I've heard about something about how couples maybe can kind of combine their pools. Is that something that works in a policy? If I have a husband and wife or partners, how's that work?
Yep, absolutely. That's my half. So when I said I think I have 4.5, that's my half.
Okay.
Because the half is what's called a shared care.
Mm.
And so it links, a normal policy says, Mark has a 3-year benefit period and my wife Leah has a 3-year benefit period.
Mhm.
You can add a shared care rider that says if Mark uses up all 3 years of his, he can start dipping into Leah's 3 years of benefits.
Mhm.
So what we end up having is this 6-year shared pool. Because the average, depending on which surveys you're looking at, the average length of stays in homes is somewhere between 2.5 and 3.5 years.
Mhm.
I think it was Yogi Berra who said, if you put 1 foot in a bucket of boiling water and 1 foot in a bucket of ice water, on the average, you're comfortable. So when we say that Mark has 3 years and the average is 3 years, well, Mark could potentially use none.
Mhm.
But maybe Leah needs 6. And so it allows you to sort of take those 2 people and sort of spread out those averages. But I really like the shared care rider for couples. And it allows that again, that flexibility, like you said, to when you're looking at the overall pool or overall aggregate, you end up being able to smooth that out a little bit better there too.
We have a question from the audience that I think is important. I'm going to throw that out to you now. And the question is, does that mean that benefits don't have to be used sequentially? In other words, can you start and stop taking benefits from that pool? It sounds like you can.
Yes.
You can control that.
Great question.
Yeah.
I love when questions and you say, oh, people are paying attention. It's my favorite. Yes. So with that elimination period, you only have to satisfy that elimination period one time in your lifetime. And so you could, in theory, be on claim for, let's say, 2 years. You satisfy that 90-day elimination period, you receive 2 years of benefits, and for whatever reason, don't need the policy anymore. You don't use it for 2 or 3 years and then have a relapse. You can pick up right away and start receiving benefits. You don't have to satisfy that 90-day elimination period again. And there's no new waiting time or anything like that. Or
you could have home care, for example. You could hit the elimination period, satisfy that period, have home care for a period of time, recover and do better, and then maybe 6 months later need to go into a facility. So in that way, start and stop too. Sounds like.
Exactly. Yes, can start and stop, but I think the important thing is that you don't have to redo that elimination period each time.
Okay. I think I interrupted you before you got to number 3. So what's the third element?
Okay, I think I'm on number 5.
Oh,
so
great.
Let me make sure. So I've got the benefit period, so that's the 3 or 4 years. The elimination period, that's the 90 days.
Right.
The monthly benefit, which is how much it's going to reimburse.
Right.
And my half was the shared care, linking the benefit periods. And then the last one is the inflation rider.
Oh, okay. Yeah.
And because the costs of care keep going up like everything else in the world, except for DVD players. My wedding present, however many years ago, from my 5 best friends was a single disc DVD player. We thought it was the coolest thing. And now knowing what I know now, I wish they would have done something else, because
I was gonna say, man, if you still got a DVD player, we got to talk.
I still have the VHS player.
All right, back to long-term care.
Back to long-term care. So the inflation rider, that $5,500 today is going to pay for, let's say, $5,500 worth of home health care today, which might be the average today.
Yep.
But if it stays at $5,500 in 20 or 30 years, when people might need the policy, it's not going to have the same purchasing power. Yep. So we add that inflation rider, and right now, for the most part, we're looking at a 3% inflation rider, so that $5,500, to the best of our ability, is going to, if that can cover most of the cost for home health today, we're hoping and expecting that costs are going to keep going up, but these benefits are going to keep increasing too, so that if we're trying to match what home health care costs are today, we're doing our best guess to try to match what it is in the future.
And that's such an important component. I can't emphasize enough how important that piece is. Sometimes when we're reviewing potential policies with clients, they ask if that's important. I can't tell you, more times than I care to, I've met with clients or new clients that have policies that they had gotten a number of years ago at, say, $100 a day, which seemed to be perfectly adequate, but for whatever reason, they didn't pay the whatever it was, or didn't elect the inflation rider when they had the opportunity to, and where it could have gone up to $200 or $300 or $400 a day by now over time, they still have a policy, but it's only going to cover $100 a day.
Right.
So that's an important piece. I want to do we have another poll question that I want to put out. If we can put that up. Really, I'm curious about the audience's experience, because sometimes people have experience and sometimes they don't. Here's the poll question. Personal experience with long-term care, either for yourself or a family member. And if everybody will just take a minute and answer that question. Let's see let's see how the audience is, what kind of experience people have with long-term care personally. You know, I'm especially happy, Mark. I'll share some of my own experience. You know, my folks went into a CCRC in Florida, a continuing care retirement community, and my brother and sister and I were so happy when they did that. We had a long family conversation about the affordability and that kind of thing before they went in. But I got to tell you, that was the best decision ever. And through that, they needed, both of them needed the assisted living component, and both of them needed the long-term care component. They did have long-term care insurance. It integrated beautifully, and it was a great thing. So here's the answer to our poll question. Have you personally had experience with long-term care, either for yourself or a family member? 67% say yes. So very common, common for folks to experience it. 33% said no. So lots of experience out there. Let's go on and talk about, thanks for kind of covering the basics there. Sure. What's the best time? I get this question all the time from clients, or I have over the 20-something years I've been doing this. Is there an ideal age at which we should apply for long-term care or consider it? And is there an age at which we're too old to consider it? Is there kind of a sweet spot or an ideal age when we should be thinking about long-term care coverage within our planning?
So that's a great question. I have two answers to that.
Yeah.
The first answer is, the younger you are and the healthier you are, the easier it is to get a policy. There is health underwriting, and so a lot of times, especially with long-term care, if as soon as you tell your doctor something like, I'm starting to feel forgetful, that ends up being a big red flag. And a lot of long-term care companies will just say they may not offer coverage because that to them is looking at a sign of dementia, an early indication of dementia. And my grandmother had Alzheimer's. She lived a very long time, but needed a lot of care. So that is someone who is that is a very large potential claim for a long-term care company. Some other things, like certain types of cancer, long-term care companies really, after you've been cleared for 3 months or 6 months, they don't necessarily care, because that's generally not going to be a chronic disabler. So the younger and healthier you are, the better it is to apply. My life experience tells me that probably somewhere in the mid-50s is a good time to start thinking about it, and maybe going off. I don't know how old everybody is on the call, but 2 out of 3 people said they've had some experience. Somewhere in the early to mid-50s is when we start to a lot of times be that sandwich generation.
Right.
I've seen it with an aunt and uncle. I've had to be a caregiver, care coordinator, care provider for mom and dad. So these things that don't necessarily seem real to me when I'm 30 or 40, now all of a sudden I've had to be in charge of this, and how great would it be if I was able to relieve some of this burden from my own kids. The other thing that happens is, when we're in our 30s and our 40s, we're worried or more concerned about accumulation. Right. I need disability coverage to protect my income. I need life insurance if something happens while I've got a 3 and a 5-year-old at home.
Yep.
But somewhere in the mid-50s, our mind starts to shift between, because right now I have a hard time visualizing retirement. I mean, when I drive by the gas station, see $100 million on the Powerball, I can visualize retirement real fast. But on a day-to-day, I'm not there yet. And I think, again, experience tells me somewhere early to mid-50s, we have that mind shift between, I do have some assets. Now, I want to make sure we're preserving. I'm going to keep building, but now I have a little more preservation instead of accumulation slant to everything. All of those things, experiential, from my experience, tell me that's early to mid-50s. We're still in good health. When is it too late? A lot of companies stop offering coverage 70 and older. So there is going to be an age cutoff. But I would say usually 50s to 60s, all is in that time frame. Obviously, the earlier the better. If people are really on track with all of their financial goals and some of those things, just it makes the application and likelihood of getting a policy that much easier.
Yep. I'll tell you, for a lot of professionals, especially in specialized professions, physicians, some attorneys and others, where we may have a disability policy that's very important during their working years. Things that I've noticed over the years is once we get into the mid 50s or so, start looking at how does long-term care fit into that? And if we've been paying premiums for disability insurance for all those years, you certainly don't want to get rid of it. But at some point, if I'm going to go on disability, I may end up going on claim for long-term care. It may make sense to kind of think about swapping out or adding the long-term care piece at that point and eventually dropping the disability. And I'm already used to paying those kinds of premiums.
Yeah. It's a great way of thinking about it.
I had a question come in on the side that I had to pay attention to for a second. What kinds of things affect the cost of the premium, Mark? Because I mean, age we're talking about now, I think must be one of the things that affects the cost of the premium.
Right.
Probably some of the other things that you talked about, those other elements. I imagine all those things kind of work together, but when we look at how much is it going to cost a person for this insurance, what are those elements that add up, and which do you have a sense of which thing adds the most to the cost of the premium?
Sure.
How do we think about that?
Okay. So the easiest one to think about is the monthly benefit.
Right.
So a $5,000 monthly benefit is half the cost of a $10,000 monthly benefit, all other things being equal.
Okay.
So that's I think to me, that's the easiest one to think about.
That makes sense.
When we think about the benefit period, there's not a giant difference to go from 3 years to 4 years or 4 years to 5 years. Because if we think about everyone who used a 5-year benefit period also used a 1-year benefit, also used 1 and 2 years of benefits, but not everybody who uses 1 or 2 years of benefits may live long enough to use 5.
Right.
So your short term is going to have your most likelihood built in, and then adding those extra layers is not going to be a proportional increase by adding extra years at the back end. Elimination period, we touched on that a little bit. The 90 days is sort of the benchmark. There's a fairly small lowering by going to 180, but a big increase to go shorter.
Yeah.
And then the inflation option, because we're in a low interest rate environment, the 3% is sort of everybody's sweet spot right now. If we tried to do a 5-year inflation option, I've seen where that adds sometimes an extra 50% to the premiums, because insurance companies are assuming over the long term that they may be able to earn 3% pretty regularly. Today, trying to say we're going to earn 5% when we're in lower than that, you have to charge extra premium basically to almost create your own.
Right.
And so that adds a big additional cost to it.
That makes sense. A couple of other questions, and I do want to touch on the kind of the COVID impact of this, but in our world, taxes are a big deal. And actually, before I ask this question, I'll remind the audience, if you have questions for the end, go ahead and enter them either in the chat or the Q&A. We'll be covering questions in a few more minutes, so go ahead and launch your questions if you'd like. We will have 2 more poll questions that we're going to put up just at the end, but that'll be at the end. So go ahead and launch your questions. But so back to taxes, Mark.
Okay.
Are there any tax advantages, or how do taxes play into the cost of long-term care insurance? I know for a while there, it seemed like the government wanted to encourage people to get insurance, to get long-term care insurance. But how does that work? Are there any tax advantages?
Sure. So, and I think the government has a long way to go, and what they could do. But the good news is, like health insurance, any benefits you received are not taxed.
Mhm.
And so that's a good part to it. When you pay long-term care premiums, part of the premiums can be deductible. So as an individual person, the IRS sets a table that says for certain ages, you can deduct up to X amount per year of your long-term care premiums.
Mhm.
But then there's also but it also has to be that amount plus all of your other medical expenses has to be over, it used to be 7.5% of AGI. I'm not sure if it still is there. But basically the IRS says you may be able to deduct $1,000 worth of your medical expenses of your long-term care premiums, but that has to be added into all of the other medical expenses, and then only in the amount over the AGI threshold. So yeah, it's a yes, but.
Right. So it gets
business,
added, the cost of the premium, depending on your age, can be added to your overall medical expenses. And if you can deduct it, then it helps your ability to deduct the cost.
Right.
Yeah.
Businesses have a lot more deduction options. And so that's a nice for self-employed people, or even C Corps have some of the best rules on it, where it's not included in income to the employee, and benefits are still tax-free. So there's some neat benefits for self-employed people, but for the normal person buying it, there may be some deductibility, but like I said, for the most part, it's a yes, but you can't, generally, it's not the whole amount. There's some limit, and it's got to be added with everything else.
Mm-hmm. Okay. I want to circle back also to one more issue that you reminded me of a minute ago, which was, you talked about dementia, and that's the one thing that really concerns me when I'm working with clients and we're looking at coverage. And one of the reasons I'm really reluctant to kind of reduce that monthly benefit or make that premium, that benefit pool too small, because we have experienced clients who have had spouses, and had clients have gone into memory care.
Yep.
And it's gone on for years.
Right.
And we've seen, unfortunately, people just devastated by those costs. I mean, it can go on. We've seen it go on for 6, 7, 8 years or more, and that's a big deal. How do you think about that? Is that a concern? How do you factor that into kind of the overall calculus for helping people figure out how much benefit to have?
Sure. And while not exactly hereditary, there is some link that says it's if you have a history of it in your family, you're more likely than someone who doesn't. Like I said, not directly correlated. So if someone has a history of Alzheimer's and dementia, that may be a good example for someone who we may look at a longer elimination or a longer benefit period than someone without. Or especially for spouses, when we add that, we have both spouses have a 4-year benefit period, but you add that shared care rider. If one has dementia early onset, now we have essentially 8 years that one person could draw down. It sort of leaves the spouse without any, but maybe we just sort of hope that if one person needed 8 years, that they've had enough hardship in life, and that the other will be okay, not needed.
Yep. It all comes down to affordability and really making choices, I think, that make the most financial sense and covering risk.
And like we said, it's all about balancing. We can show you insurance policies that will cover 100% of everything for however long you might possibly need, but those premiums are going to be so high that it will probably impact something else. And so every day is just that, as you know, I'm sure you know better than me, every day is a balancing act of, we have X coming in, and Y we want to go out. How do we do that?
Right. We have a question from the audience, and I think it's pertinent now. The question is, I think we might have covered this, but maybe not. Doesn't current and health age affect cost? I think what they mean is, doesn't your current current health affect the cost? Certainly, we address the age thing. The older I am, probably the higher my premium is going to be. Other than that's a good question about age. I think I get it. The underwriting for long-term care insurance, do they? Is it just kind of a yes, no, we're going to approve you or we're not going to approve you, or might they approve me, but it's going to cost more because of some health consideration? How does my current health affect the premium?
Sure. So to answer both of those, to go from age 55 to 56, all things being equal, there's a little premium increase. It's not really significant from any one year to the next. Health-wise, with life insurance, we might have 20 different rate classes: super preferred, standard plus. With traditional long-term care policies, there's normally 1, 2, maybe 3 rate classes. And so you have a very large standard rate class, which is what most people have. And then you may have a substandard category or 2, and then a non-issue of coverage. So there's much fewer levels than with the traditional life insurance policies, let's say. But there's a much larger sort of standard rate class that people are going to fall into.
Yeah. And you might have touched on this before, but are there certain health issues that are automatically going to eliminate me that I shouldn't wouldn't even bother applying if I had certain health conditions? Are there a few that are real obvious or not?
There are a few, and probably if you can think about it, and we didn't touch on this, so I'll touch on it real quick. How do you qualify for long-term care benefits? How do you become eligible for benefits? So it's the inability to perform without hands-on or standby supervision 2 of the 6 activities of daily living, which are eating, bathing, toileting, transferring from sitting to standing, continence, and there's always one that I forget. So can't do two of the 6 activities of daily living or have a cognitive impairment like Alzheimer's. So I mentioned that any sort of history of forgetfulness, confusion when you share that with your doctor, that's going to be an automatic decline. And in general, things that require where somebody is already having issues with those things. One that surprises people is a knee surgery. You're probably going to be just fine after you have your knees done. You're probably going to be better than when you had it done. But at least in the period of time where you're receiving physical therapy, long-term care companies are not going to offer coverage. They want to make sure that it went well, you've completed your physical therapy, and you're back to normal. And so it's more of a postpone than an automatic decline. But at least at that moment, it's a no. We need to wait a little bit.
Yep. Interesting. So any kind of chronic condition that would affect my ability to do those activities of daily living. Seems like that's something to consider. Yeah. Right. Okay. We have another question, which I think is interesting about, policies. They said, is there such a thing as a single large premium long-term care policy? In other words, could I, instead of paying a premium every year for years, could I just, make one payment and get it over with? Is there something like that?
Yes, and this is where a lot of companies, when we talked about the number of traditional long-term care companies sort of thinning down, a number of other companies have come out with life insurance policies with long-term care riders that have the same $5,500 of monthly benefits for your benefit period, 3% inflation rider, but being built on a life insurance contract, you can do some neat things like have that single premium. And it also has maybe a cash value if you never need it, a death benefit if you, and Michael, you touched on this, if I don't want to pay for something I'm not going to use, I hope I don't get in a car accident, but I'm going to pay in my auto insurance. I hope my house doesn't burn down, but I pay for my house insurance. But these policies allow some flexibility for something like a single premium, and knowing that, well, if you never need it, then there's some death benefit there additionally.
Okay. So that's interesting. So for the right case and the right circumstance, might want to look at that. I've always been a little skeptical about those kind of annuity or life insurance hybrids, but it sounds like
Mhm.
there can be some usefulness. They might work. Do they provide the
Right.
same kind of reimbursement benefits that a traditional long-term care policy provides?
Some are reimbursement and some are even what's called indemnity.
Hmm.
And that means that once you go on claim, you get the $5,500 per month without having to show those expenses
Oh,
every month. And so it can be a little more flexible on, who's providing the care sometimes.
okay, good to know. Um, let's transition and talk about the COVID, the impact of
Mhm,
COVID on long-term care. And
mhm,
I've got a question. We've got a question from the audience saying they have had a traditional long-term care policy for over a decade now.
mhm.
Um, do we expect that the pandemic has affected the premium or the coverage for existing policies at this point, or what are we learning from COVID, from the pandemic, and what's the impact been kind of moving forward
Sure.
that you're aware of?
Sure. I think the biggest impacts that we saw were on the underwriting.
Hmm.
And initially, insurance companies not really knowing what's going on, and so many times they really pulled back on who they were offering policies to, depending on how old you were.
Hmm.
That's all sort of settled out, and most insurance companies, I think a few would offer coverage to people up to age 79. Right now, they're maxing out at 70, so not big changes. But overall, I don't expect it to have much impact, because a long-term care policy, in order to receive benefits, you are not able to perform those 2 of 6 activities of daily living,
Hmm.
or you have a cognitive impairment, and it's expected to be a long-term thing, which I think is 180 days in those contracts.
Hmm.
So from what we know about COVID, or at least what I know, which isn't much, let's be honest, is that that's not really what's happening. There's not that many people who are getting COVID and then aren't able to do those things
Right,
for 6 months.
right.
So and not to not to sound callous at all, but if somebody dies soon or doesn't meet their elimination period, the insurance company didn't pay out a claim.
Hmm.
And so, and you mentioned early on all the COVID and the assisted living facilities. From the long-term care company, those people were already there. So COVID didn't cause them to go into a facility.
Right.
And now we may find out that people who are already in facilities, this maybe causes them to have more things that cause them to need more care.
Hmm.
But at least the news that I've read would be that it's more likely that people who are already there who get COVID maybe die at a higher rate than people who didn't. And so from a care, the insurance companies, what they would look at is how long are claims continuing, and they may not be continuing longer claims because of COVID.
Yeah. So probably not not in the ways we might imagine. I do want to circle back though in terms of people who do have existing policies. The one thing that you raised about interest rates
Hmm.
may have an impact in the future more than COVID, but the low interest
Right.
rate environment certainly seems to have put stress on insurance companies. And I think we've seen some premiums go up.
Hmm.
Used to be years ago, they used to say, you pay this is what your premium is going to be for the rest of your life. And oops, it
Right.
turned out to not quite be the case. Are you
Right.
seeing insurance companies raising premiums as a result of the
Mhm.
low interest rate environment?
And that's absolutely. And I think that's if I get up on my soapbox for just 30 seconds, like you said, a lot of companies, it was a feather in their cap to say, we've never raised rates.
Yeah.
Um, Unfortunately, I think they were saying that 5 or 6 years longer than they should have. And had early on insurance companies told us, you know what, we need to adjust your rates by 2%. We're all used to things going up. I have a hard time figuring out my cable bill. It seems to go up and down every month. I've given up.
Hmm.
So we just get used to things increasing a little bit, and had rather they I wish in hindsight that they would have said, this is what's coming. We need to start having incremental changes so people can change, rather than nothing, 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 where we've applied to the states and we're requesting a 10% increase or 15% increase.
Yep.
I wish things would have gone differently in the past, so we could have, it wouldn't have surprised as many people. But yes, when you price a policy in the 80s, assuming 6% rates, and we're not earning that, we're going to have the rate increases. Unlike my DVD player, though, that was really expensive in the past and has come down, every year that you've paid less on that long-term care policy than what it would cost today, everybody's better off. And one of the things that I do a lot is policy reviews. If we look at what your policy costs today, even with a rate increase, to get a new policy today is probably 30, 40, 50% more than what you're paying. So you've been paying below market rate every year. And even with the rate increases, you're still paying below market rate. We just don't like hearing that it's increasing, but hope that helps.
Yeah, and I can't think of a single case where we've reviewed a long-term care policy where the premium was going up and did not recommend paying the extra, paying the increase and keeping the policy. It's still it's still good to keep the policy. It's still in a lot of cases those older policies have some nice benefit.
Right.
Mark, we're about to wrap up, and in a minute I'm going to put up our final questions, but is there anything that I should have asked you about long-term care or the impact of COVID on long-term care? Anything I should have asked you that we need to cover still?
No, I don't think so. It's always changing, and so that's the interesting part about the long-term care world, and as you mentioned, from lots of companies to fewer companies to companies consolidating. But I think it's still something that's really important for a lot of people. You have a group of people who are maybe Medicaid eligible in the short term. You have some people who probably could self-insure for whatever they want to do, especially if they hit that Powerball after they drove by my gas station, my example. But then for a lot of us, it's I have some assets. I probably could, but if I needed the $120,000 a year in a facility, that's money that I'm not leaving to my kids. Or it's not necessarily that I'm worried about running out of money truly and becoming impoverished. It's that I'm worried about running out of money so that I don't have it for other things, and the ability to pay pennies for an insurance policy for dollars of future benefits just helps mitigate a lot of that risk.
Yep. Well, thanks everyone. And Mark, I want to thank you for your time today. It's been a pleasure.
Absolutely.
Like I said, we really enjoyed working with you, and I know we'll be continuing to work together, and maybe we'll do another one of these sessions down the road. So
happy to.
Thanks for your time. Thanks everybody for joining us today, and see you next month.
Okay. Thanks, Michael. Appreciate it.
Yep. Bye.